Core CPI ticking up 0.5% in February. Inflation remains a pain point for the Fed, and rate hikes still in the spotlight, especially as concerns over the financial stability risks in the banking sector rise following the collapse of Silicon Valley Bank. And here to discuss all of this and more is Bill Smead, Smead Capital Management CIO. Bill, always great to see you here. So big picture, what's the Fed going to do given this latest uptick in CPI, especially the core services here?
Boy, I don't consider myself a Fed whisperer, but you've got them kind of caught between a rock and a hard place because they need the economy to continue to percolate along, which is percolating along for people with in the bottom 90%, not the top 10% of incomes. What we're having already is what my co-manager Cole likes to call it a rich session, right? There's a recession among rich people. Their capital has been damaged. Now their bank is threatened. These are problems for extremely wealthy people, and average folks are seeing their wages go up sharply, deservedly so, because their labor is highly valued. And it's a great irony watching. Just think of how long we went with shows like the Rich and Famous shows, you know, with all the wild houses and et cetera. Well, now we're going to have just the opposite. The show is going to be about how much life has gotten better for average folks and how miserable it is for the rich folks.
Well, I don't know about that if we continue to see food inflation go at the rate it's been going. But point taken, Bill. I want to ask a little bit more about what we're seeing as the result of the fallout from Silicon Valley Bank, right? Because it's been really interesting, the action we have seen in other banks over the past few sessions, right? Particularly regional banks, which plunged and now are coming back. Some of the larger banks have held up better. But I suspect you probably have some banks in your portfolio. I know Warren Buffett, who you track closely, has some banks in his portfolio. And so is it going to be more costly to do business as a bank coming out of this whole thing?
Well, yeah, we own Bank America and JP Morgan and American Express. And it looked to me like foolishness for people to sell them in reaction to this, because you're right. They're just going to get stronger out of this. But I think you got to put all of this stuff into context. A bear market started in late 2021, and its purpose is to clean the investment markets of the egregious chicanery and foolishness of the prior 6 or 7 years. We had nearly free money for 5 years. And when people are allowed to use free money, they do a lot of really stupid things with the free money. Charlie Munger called it the biggest financial euphoria episode of his career because of the totality of it. And what did he mean by that? He meant that it wasn't just FANGs, it wasn't just techs, it wasn't just high price to sales stocks, it wasn't just the Beyond Meat market and the Peloton market, it was crypto, memes, IPOs and SPACs, et cetera. So what you do is we went back and looked and said, what prior markets had to clean the system, being a stock market system? And that would be 73, 74, and 03, the Nifty 50, and then the dot-com bubble. Well, the weird thing about this one is we have both the Nifty 50 bubble and the dot-com bubble at work at the same time. And Silicon Valley Bank was symptomatic of the dot-com bubble. What is going on here is free money has gotten into the hands of numerous startup businesses, and then all of a sudden the IPO window closes and everyone is going to reassess at what terms they're going to get involved in a new venture. And let me tell you, all those reassessments are dramatically lower. In fact, most of them won't happen because the endowments and foundations and family offices that used to just love to lavish money on private equity people and love to lavish money on the venture capital market, they're not going to touch a thing for a while. And the chain reaction of that is going to be entertaining.
Well, Bill, I like these historical analogs. I also like that you're going back in time and not just going back to the 2008 global financial crisis, because in my personal view, that's more apples to oranges here. But getting back to the dot-com crash, that was slow motion in a lot of ways. It took a year for the recession to onset from the prior stock market peak. It took about 3 years for the stock market to finally find its footing here. In the meantime, we had Enron play out, we had WorldCom. What can we expect in the intervening time here while we're waiting for markets to find their footing?
Right. So you hit on a great point. So the analogy is the rhyme is so strong here that the Y2K changeover caused for 2 years all companies and all governments to buy new computers, new servers, new software, new routers, new phone equipment, new everything, right? Because when January 1 hit, they didn't want the world to stop. Well, what happened was you got to January 1, the world didn't stop, but every company had purchased every bit of technology that they were ever going to need for like 4 or 5 years. Well, fast forward, we closed the economy in 2020. We literally shut the economy down. The federal government spent between two administrations about $8 trillion of borrowed money to prop up the economy while we had it closed down. And what did people do? They put up a home office and they put in a bunch of technology stuff. And if they were a business, they put technology stuff in to do a Zoom call like this and all the things that go with it. And so what that did was it just created an additional 2 years of legs to the mania that Munger was talking about, the same way Y2K extended the dot-com bubble. And by extending it, what you do, I'm not Catholic, but I think if you're a Catholic, the penance has got to equal the sin, right? And so we think we're at about halftime of this bear market.
So, Bill, if I can dig into that a little more, where's the penance coming from? In other words, what's failing next? Are we going to see more bank failures, do you think? Are we going to see, it sounds like you think startups are going to go under. Do you think VCs are going to go under? Do you think private equity firms even are going to start to have problems? Where are you looking for the next blow up?
Well, it's a great question. The first thing I thought of is what I don't think anyone's mentioned, right? It's so funny. The first thing I thought of is, okay, when a startup does get funded, what do they spend money on? Where does that money go in the early stages of a startup during those years when all of them have no profit, right? They're growing their revenue, but they have no profit, profitless growth, right? So who are their vendors? Who do these companies spend money on? And who was Silicon Valley Bank and Signature Bank were very intertwined with the movement of that money. Where did it go? It went to web hosting. It went to online ads at Facebook and Google and Apple and Amazon. It went to Amazon Web Services. It went to Microsoft and the other software vendors, et cetera. No one's even talking about that. We're shutting down this huge ecosystem of startups and IPOs, et cetera. And they're treating these companies like there's not going to be any fallout at their end. It just, to me, it's absolutely remarkable. They're all web hosted. They're all using cloud services. It's like people have been bidding up Amazon as a safe quality stock. And one side of Amazon is a profitless e-commerce business. And the other side is a cash gusher that has customers dropping like flies.
Well, I mean, but you're not suggesting Amazon's going out of business.
No, not at all. What I'm suggesting, and the reason I like bringing up 73, 74, at the end of 1972, Coca-Cola was trading at 60 times earnings, and Disney was trading at 80 times earnings at the end of 1972. When I came into the business in 1980, those stocks were single-digit multiples. Now, you tell me, if we go through a 3-year bear market, is Amazon going to make it out of here with a 60 multiple?
It seems like if they really,
no.
I think that's a no. I think that the question was a bit rhetorical, Bill, but yes, I think that's something that investors should be looking at if they're thinking it's going to recover in a shorter period of time. We got to leave it there, Bill. Yes.
Yeah. Well, one more thing on Facebook. In normal times, they make fun of businesses that are laying people off. The old term was you can't cut your way to prosperity. So here we are halfway through a 3-year bear market, and they're bidding the stock up that's laying people off as if you can cut your way to prosperity.
It does seem to be very popular to cut these days, Bill, but your point is well taken. We could spend a whole hour with you, but we got to go. Bill Smead, Smead Capital Management, CIO, great to catch up with you. Thanks for the historical perspective and much more. Appreciate it.